Hello and welcome to our new investment strategy update. An intense few months lie ahead for investors. The stakes are high in geopolitics, economic policies, and US politics. But beneath the headlines, a powerful investment cycle is lifting global growth. What began as a US tech and AI story is now much broader. Capital spending is spreading to energy, infrastructure, and defense as many countries look to build strategic resilience. This is supporting demand, infrastructure, and corporate profits. While US policy uncertainty, tariffs, and Middle East tensions may continue to create volatility, they are unlikely to derail the expansion. The US economy remains robust, consumers continue to spend despite pressures on real incomes, investment is strong, and the labor market stable. So far, US growth is not generating underlying inflation, and core inflation is declining while tariff levels remain broadly unchanged despite legal framework changes. Therefore, there is no reason for the Federal Reserve to raise interest rates. Inflation may take longer to reach target, and we can't rule out a couple of rate hikes. But such moves would not alter the broader growth or inflation outlook. In other regions, the picture remains constructive. In Europe, growth has also held well despite the Middle East conflict. Concerns that energy could stoke further price pressures should prompt a further but final rate hike by the European Central Bank in September. In Japan, stable growth, government spending, and inflation expectations argue for further interest rate hikes by the Bank of Japan. In China, weak domestic demand is prompting authorities to bring forward spending plans, but goods exports have been stronger than expected, and the economy also benefits from the global investment race to dominate AI. Looking ahead to next year, some of today's tailwinds will fade. Less supportive monetary policy, less US fiscal support if the midterm elections deliver a divided Congress, and rising political risks in Europe. But the foundation of the global expansion remain in place, keeping recession risks at bay. So let's now discover the investment implications with Nanette.
There has been no shortage of challenges for investors this year. Conflicts, uncertainties around US policies, the transformation of the global economy through AI, and the US-China race to dominate it. That's a lot for markets to absorb. Yet, despite these shifts, markets have remained remarkably resilient. They're being supported by one of the most powerful investment cycles in modern history. Corporate profits are strengthening and creating opportunities across markets and sectors. That's why we have stayed largely invested through periods of turbulence. We enter the final months of the year now with still a pro-risk stance. Financial conditions remain benign, and the risk of a Fed hiking cycle is, in our view, low still. Market performance is set to broaden further. A strong earnings outlook underpins our overweight to both developed and emerging market equities. And in the US, we see signs that tech firms are now monetizing their vast AI investment. So earnings growth is spreading beyond tech. Globally, we favor the healthcare, utilities, financials, and materials sectors. Now, sovereign bond yields have climbed this year. But as well as solid growth prospects, long-dated bond yields also reflect fiscal, inflation, and policy concerns. So we stay neutral here, as well as in corporate bonds. The most compelling income remains in emerging market hard currency debt, in our view, which we overweight. An environment where markets expect tighter monetary policy but resilient growth tends to support higher yielding currencies, such as emerging currencies, over lower yielding ones, such as the euro and the Swiss franc. On the dollar, we stay neutral. Rising investment and a robust growth are a powerful combination for investors. But we expect an intense few months ahead. Geopolitics, Fed policy uncertainty, and swings in AI sentiment could all spark volatility. The waves created by political risks and shifting economic currents are rising. Investors will therefore need discipline and vigilance. Thank you for watching.